I now hand the conference over to Mr. Pankaj Harlalka, Head Investor Relations of Shyam Metalics and Energy Limited. Thank you, and over to you, sir.
During our IPO in June 2021. Today on the call from the company we have Mr. Brij Bhushan Agarwal, Vice Chairman and Managing Director, Mr. Deepak Kumar Agarwal, Whole-Time Director Finance, and Mr. Deven Dhruva from Orient Capital, our investor relations partners. We have uploaded our investor deck and results highlights on the stock exchanges and company website. I hope everybody had an opportunity to go through the same. Since our company has just been listed and we are doing the earnings call for the first time, I would share a brief overview about our company, its journey, and then request Bhushan sir to discuss the growth strategies going forward. This would be followed by operational and financial performance for the quarter and year ended FY21 by Deepak Ji Agarwal. Post that, we will open the floor for question and answers. I would humbly request participants to restrict their queries to the quarter results under discussion, as we shall soon also come out with our June quarterly results. I hope you all are keeping safe and healthy during these times. I thank you all for taking time out of your schedules to attend this call. We are pleased to introduce Shyam Metalics and Energy, an integrated ore-to-metal company present across the steel sector value chain in both non-alloy steel and alloy steel. We are a new entrant in the metal space with a history of 17 odd years and have recently listed on NSE and BSE with effect from 24th June 2021. The current market cap of our company is approximately 10,800 crores, making us among the top 7 steel players in the country in the listed space. Our diversified product profile, our unique business model, our cost leadership, both in terms of capex and opex, have facilitated us in maintaining consistency. We are amongst the only metal or steel companies who have reported a positive PAT in each of the last 15 years of our existence. Our disciplined capital allocation policy of implementing capex through internal accruals and take recourse to borrowings to meet our working capital needs have helped us deal with 4 rough cycles and carnage faced by our industry over the past 2 decades with our heads held high. We have had a phenomenal CAGR growth. Revenue growth has been 22%, EBITDA growth has been 34%, and growth in terms of capacities has been 31% over the past 17 years. Sticking to what has worked for us in the past, we already have expansion plans in place to grow organically and diversify our product basket in the metal space. Our expansion plans are brownfield in nature and are coming up in our strategically located existing plants. While all that we produce has the scope to be exported, we are shielded from the threat of imports. We are only in the long product segment of the steel industry and have not seen any imports in the country for products manufactured by us and segments catered by us in the past. We are situated on the bed of raw materials, and all raw materials are abundantly available in close vicinity, facilitating cost leadership for us. We have over the years invested in world-class infrastructure and upgraded our technology from time to time, which have reflected in better financial performance. We have private railway sidings in 2 of our major plants. We follow a model of waste to value in designing the modules and have always believed in creating a fine balance in capacities, which have further led to consistency of performance and assisted in the steady growth of our company. We have captive power plants majorly based on waste heat recovery from our DRI kilns. The low cost of power is majorly used to support and meet the requirements of our ferroalloy plants, making us one of the least cost producers of ferroalloy in the country. We are one amongst the largest ferroalloy producers in the country, the 4th largest sponge iron producer, amongst the largest pellet producers in the country. We are a CRISIL AA rated company, a feat achieved rarely in our industry, with one of the lowest gearing ratios amongst our peers. At no stage in the history of our company, our debt to equity has always remained below 0.5x to our equity. Our model has led to consistency in terms of EBITDA margins, strong cash flows leading to funding of capex and growth in capacities. Adherence to mantras like phased capex in smaller modules have resulted in steady growth and consistent returns on equity. We have over the years built a very strong risk management system which has been formulated by an experienced board and senior management team. We primarily produce intermediate and long steel products such as iron pellets, sponge iron, steel billets, TMT, structural products, wire rods, and ferroalloy products with a specific focus on high margin products such as customized billets and specialized ferroalloys for special steel applications. Our TMT and structural products are sold under the brand SEL, S-E-L. We also undertake conversion of hot rolled coils to pipes, chrome ore to ferrochrome, and manganese ore to silicomanganese for an Indian steel conglomerate. We are also currently in the process of further diversifying our product portfolio by entering into segments such as pig iron, ductile iron pipes, and aluminium foil. We currently operate 3 manufacturing plants that are located at Sambalpur in Odisha and Jamuria and Mangalpur in West Bengal. The aggregate installed metal capacity of our manufacturing plants was 5.71 million tons, comprising of intermediate and final products. Our manufacturing plants also include captive power plants with an aggregate installed capacity of 227 megawatts. Our Sambalpur and Jamuria plants operate as a ore-to-metal integrated steel manufacturing plants and comprise captive railway sidings, captive power plants, and captive reservoirs for water. Our integrated manufacturing plants are fungible by design, which provides us with the ability to quickly adapt to continuously evolving market conditions, change our production and product offerings, and optimize our operating margins, thereby insulating us from price volatility. We have 8 captive power plants that utilize non-fossil fuels such as waste, rejects, heat and gas generated from our operations to produce electricity and thereby enable us to operate at lower power costs. Our Sambalpur manufacturing plant caters to customers in central, western and southern regions of India, whereas our Jamuria and Mangalpur manufacturing plants caters to customers in northern and eastern regions of India. Our product offerings cater to a mix of customers that consist of institutional customers and end-use consumers through our distribution network. The company has partnerships with 42 distributors who stock and sell our finished products across 13 states and 1 union territory. We also sell our intermediate products through brokers. I would now hand over the call to Sir Brij Bhushan Ji Agarwal Ji for his thoughts on our strength and strategies of the future. Thank you.
So the line for the management just got disconnected. Please stay on line till I reconnect them. Ladies and gentlemen, we have the management line reconnected to the call. Thank you and over to you, sir. We have Mr. Bhushan Agarwal, sir, in the conference.
Yeah. Pankaj, can I take over?
Yes, sir. Yes, sir, please.
I'm so sorry. I apologize. I think there was some problem with the connection. Anyway, thank you, Pankaj. Hello, good evening, everyone. I would like to thank to the entire investors family for the tremendous support shown during our IPO in the June 2021. Coming to the strength of the company, I would just like to share the brief about the integrated operation across the steel value chain. The integrated nature of our manufacturing plant has resulted in the control overall aspect of our operations as well as the operating margin, enabling us to focus more on the quality and create multiple points of sale across the value chain. Our forward-backward integration activities are generally undertaken by our own in-house engineering team who conceptualize and execute such activity in timely manner with the help of various in-house construction own equipment by us. This helps us to deliver our project within the timeline and within the most competitive cost. Our manufacturing plants are strategically located in the close proximity to the raw material source where we believe that we are very, very competitive on the logistic cost and also help us to plan a good time management from the inventory management point of. Since our manufacturing plant is within 250 kilometers from the mineral belt in the eastern India, including iron ore, coal, chrome ore, and so we have a very strategic advantage of creating synergy as well as achieving the economics of scale and operational efficiency. Apart from that, we have very well connection of roads. We have a captive railway siding in 2 of our plants, and our Odisha and West Bengal plants are also have a proximity to the national highway. Our Sambalpur and Jamuria manufacturing plants have a captive railway siding, and we are connected with the river for the perennial consistent supply of water to run the steel plant. We are one of the few integrated metal producing company in India with captive railway siding. We believe the strategic location of our manufacturing plant has enabled us to export our product to the international customer at a very cost-efficient manner. We have also achieved cost efficiency by utilizing the waste management byproduct as a raw material input for our product and processes. To control the cost of power, we utilize the dust, the flue gas which comes from the iron making, and the solid discharge also is utilized, including the washery rejects in the boiler, which also helps us to reduce the coal cost in steel making and capturing the value of waste to value in the power, and also add the value of reducing the cost in the power plants. We have the lowest cost of power, captive power in country in India. Captive power plant utilize non-fossil fuels such as waste, heat rejects, and gas generated from the operation of producing electricity. 79% of the power consumed is captive power, and the cost of the power is around 2 rupees 15 paisa per kWh, whereas with the current capacity of 227 megawatt. We are increasing the share of B2C and value-added products. We sell our brand of TMT across India with a stronger presence in central, eastern and northern India. Our TMT and construction bar structural steel products are sold under the brand SEL. With an array of high quality of structural products under the brand SEL, backed by world-class services and its product, SMEL holds its pride of place among the leading steel manufacturing in the country. Towards the forward integration, SMEL has set up high quality of wire rod manufacturing facility with wire drawing, with best available technology and plant and machinery. Since the raw material are manufactured in-house at our plant, the company is able to produce high quality wire rods and HB wire in a very cost and efficient manner. Coming to the expansion, I would like to state, I'm sure like all my investors family must be looking for the growth plans and the future story. I'm very delighted to state that with our present existing integrated installed facility of 5.71 million ton per annum, we are moving to 11.6 million ton per annum and increasing the captive power plants from 227 megawatt to 357 megawatt. This proposed expansion are expected to become operational between 2022 to 2025. In addition, we are in the process of commissioning the aluminum foil plant in West Bengal with a proposed installed capacity of 0.04 MTPA, which is expected to become operational in this fiscal of 2022. The total capex cost aggregating 2960 crores approximately. This year we intend to capitalize around 850 crores to further our capex plan from the internal accruals. Most of the expansions are in the form of enhancement of our existing facility, and it is in the same premises, and it is an organic expansion. I am very delighted to state that we are enhancing our pellet capacity from 2.4 million ton to 3.6 million ton. We are also increasing the sponge iron facility from 1.4 million ton to 2.9 million tons. We are also enhancing the billet capacity from 0.9 million tons to 2 million tons. In the long product and structure also, we are enhancing from 0.8 to 2 million tons. We are currently in the process to further diversify our product portfolio by setting up the blast furnace, pig iron plant, which will be a backward integration for our existing plant and add more value in the terms of the cost reductions and will increase the bottom line of our manufacturing cost. Also, the capacity expansion is focused on increasing the share of high value products. This will help the company to augment better revenue, better cost controls and increase the profitability. We intend to continuously invest in the new technology at the manufacturing plant to enhance the capacity and explore opportunity to obtain synergy in our existing manufacturing plants. This will keep our operating cost low, which we will believe is critical for remaining profitable. We all are aware about the second wave of COVID-19 has adversely affected the economy, and in these tough times, our priority was clearly to take care of our people who were working very challenging and have given their best effort. The company organized the vaccination camp and at the factories for the employees, their families, and everyone at the age of 45 has been vaccinated. More than 300 people in the range of 18 to 44 years has been vaccinated at the camp in the plant. We also have extended the health insurance program for all our employees. I would now request Mr. Deepak Agarwal, our Director of Finance, to take you through our financial performance. Thank you so much.
Thank you, Bhushan sir, and good evening, everyone. It is my pleasure to share the financial of Shyam Metalics and Energy Limited, the company which has grown stronger on year-on-year basis. Over a period of 17 years, the company came across many challenges, but it has always tried to convert those challenges into opportunities, the outcome of which is reflected in our better financial performance and consistent growth. As we all know, an ounce of performance is worth of pound of promises. So here I take pride in sharing company's robust performance with you all. Our company has reported a record number in terms of revenue, profitability for the quarter and year ended 31st March 2021. The Board of Directors have recommended a final dividend of 2.75 per share of the face value of rupees 10, which is 27% of the dividend for the financial year 31st March 2020. I would also like to add one more thing as far as dividend is concerned. For the last year, that is 2021, we have actually declared a dividend of 45.51%, and out of that 45.51%, we have declared interim dividend to the tune of 18.5%, which was distributed in the last financial year. The final dividend of 2.7 rupees per share, which will be distributed after approval of the shareholder in the ensuing annual general meeting. The Shyam Metalics and Energy Limited delivered a record revenue and profitability for the financial year 2021 on the back of strong growth backed by robust demand from the end use of industry and increased efficiency in the business. For the financial year 2021, the revenue grew by 44% to the rupees of 6,297 crore. The operating EBITDA grew by 109% to the rupees of 1,394 crore. When we talk about the PAT grew by 148% and the amount is 844 crore. The volume and also grew by 34% from 23.2 lakh ton to in financial year 2019-20 to 31.2 lakh ton in the year 2021. When we talk about the blended EBITDA per ton, we have increased the blended EBITDA per ton from the last financial year by 108% to the rupees of 11,809 rupees per ton. When we talk about the debt equity, our gross debt equity stood at 0.22x compared to the 0.39x as on 31st March 2020. I can proudly say that we are one of the lowest gearing among the all steel competitors as far as gearing ratio is concerned. We have a clear-cut policy in our system in terms of leverage is there. And the shared policy has adopted by our Honorable Chairman, Sri Mahavir Prasad Agarwal, that our gearing ratio will never cross 0.5x to the total equity, whether in the past, present, and we will also follow that policy in future. Yeah, so the net debt to the equity is stood to 0.07% compared to the 0.32x as on 31st March 2020. As far as return on capital employed, we have increased by 1560 basis point to 25.3%. As far as return on equity is increased by 1120 basis point to 23.2%. The working capital days has also reduced by 20 days from 89 days in March 2020 to 69 days in March 2021. We have already incurred a capex of 736 crore as on 31st March 2020 out of the total capex program of 2960 crore. With this, we will now open our floor for question and answer. Thank you, all of you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yes, thanks for taking my question. I have two questions. Firstly, on the inventory Can you specify how much iron ore inventory do you have at this point of time, and from which quarter, maybe Q2 or Q3, will you see high cost of iron ore seeping to your financials? And my second question is on capex. The presentation states that 22 to 25, the total capex cost aggregates to 2960 crores. I think if you can clarify the year-wise capex, and since there are no new capacities which are announced, what is the revised total capex cost for the expansion now? Thank you.
Thank you, Abhijit. Related to your first concern about the iron ore inventory, I would very pleased to state that today we are almost have a position of around 1.7 to 1.8 million tons of iron ore. And since we have a good position of iron ore inventory, and we have also a long-term contract with OMC, which is a government company, our positioning from the iron ore is very, very comfortable. And I would also like to state that this is not the first time that the concern of the iron ore has arisen. We had been facing this very regularly since last 15-17 years, and we all investors should be very proud to understand and feel that we had been able to overcome all the challenges, and we have taken the best of the advantage at the best of the time. So related to the iron ore, we are very clear. Now, your second question about the capex plan, as you know that we are very, very prudent on our approach, and we have a capital allocation policy. So the capex of 2960 crores, what we have stated, is going to be implemented in 4 years approximately. And likewise, Mr. Deepak Agarwal, our CFO, has stated that last year we had already capitalized around 750 crores approximately. And I have in my statement has stated that this year we will be capitalizing around 850 crores. So year-wise, at the different organic expansion, you beat pellet, or you beat sponge, or you beat power, or you beat the steel mill, because we are doing the major expansion on the value-added product. We are focusing in the time to come to reduce our cost by adding more power. We are also targeting to increase the capacity of the existing infrastructure so that we are able to reduce the cost and increase the efficiency more by increasing the capacity. So overall, I can tell you that on an average, if you say as a ballpark figure, around 18 to 20%, or maybe 18 to 22% year after year, we will see a growth of the capacity, year after year in the complete system.
Okay, thanks. So the capex number has not been revised. Just wanted to clarify. The capex number has not been revised, right? So it stays the same.
Yeah, I think, Deepak, am I clear, or is there any concern?
No, yeah, you are absolutely correct. The number which we have already stated, as far as in the last year is concerned, we have already incurred 736 crore in the last year, and we are planning to incur in the current financial year 850 crore, and similarly in the range of in the next year.
Yeah, Abhijit's question is, the figure what we have stated remains the same.
Yes.
As of now, Abhi, it is right. It is the same.
Okay, great. That's what I wanted to say. Thank you. That's all from my side.
Thank you.
Thank you. We would like to remind participants that you may press star 1 to ask a question. Participants, to ask a question, you may press star and 1 now. The next question is from the line of Shubham Agarwal from Equitas India. Please go ahead.
Yeah, thank you for the opportunity. Sir, first question is regarding the DI expansion. So where are we currently in terms of, by when can we commission the DI and pig iron capacity?
First of all, I would like to state that the pig iron expansion, the capacity is coming up in our Bengal Jamuria plant. And first we are going to commission the pig iron facility with the sinter plant. And later on, after the commissioning of the pig iron, we will commission the DI pipe facility. So probably I think, today we are in 2022, 21. So maybe 23, 24, to be more prescribed, we should be able to commission the pig iron facilities.
Okay, so probably then DI would come in FY25.
Correct.
Yes.
Okay, got it. And where are we in the process of approval? I believe DI is a new addition to the product line, so we would need certain approval. So have we received it, or are we in the process right now?
There is no such mechanism where we can take an approval before putting up a plant. First we have to conceive the plant, we have to commercialize the plant with the operational parameter, and then the approval comes. So these things will all come later 2024-25, for the DI is concerned.
Got it. And secondly, on the ferroalloy business, I just wanted to know what was our average realization in Q4.
Yeah. As far as ferroalloy is concerned, our average realizations for the ferroalloy for the fourth quarter is 81,000 rupees per ton.
81,000. And our product lineup would include silicomanganese and do we have any other product?
We have ferromanganese and silicomanganese.
No, but we are making medium carbon, we are making specialty alloys, we are making low carbon. So it comes from the same pedigree of manganese family and the chrome family, but we are making a lot of specialty alloy in the ferroalloy.
Got it. That's why our realization is on the higher side.
Yeah, correct. Yeah.
And what would be the realization currently?
Currently, I think it should be around 95,000 to a lakh rupees approximately.
Okay.
Yeah.
Got it, sir. Thank you. That's it from my side.
Pleasure.
Thank you. The next question is from the line of Arijit Dutta from Axis Capital. Please go ahead.
Hi, sir. Congratulations for a good set of numbers and very successful IPO. My question is regarding iron ore prices. Currently, in this quarter, what would be our average iron ore prices that we have booked? Question number one, followed by the iron ore inventory that you just mentioned about 1.7 million ton. What would be the average cost of that? And for example, like 2 quarters down the line when we will be exhausting the iron ore inventory that we have, based on current prices, how much increase that you are seeing on the iron ore inventory that we will be making? Thank you, sir.
Thank you, Arijit. First of all, related to your first question, I would like to state that, today with our good inventory strategy on the iron ore, we are not very aggressively in the market of procuring the iron ore at a crazy price. Most of the iron ore is still, we are fetching from the long-term contracts, what we had booked earlier. Apart from that, I can share that yesterday there was a sale tender where we have taken a iron ore at a price of around 5,400 rupees approximately, So this was a level what we took yesterday. But on an average, if you ask me, I will not be 100% sure, but I can just share that maybe this quarter we may be landing around 6,500 rupees should be the price of the iron ore. And related to the this iron ore of 1.7 1.8 million ton present stock, and we also have a position. I think we are very comfortable for next, because we are buying under the long-term contracts. We have lot of advantage of our good positioning of iron ore. So we will be carrying out for a pretty decent time. And related to the few next year strategy, I can very well share that, lot of the mines which have gone with OMC, they have started their commercial production. Like you beat Gelling, you beat this Gwali mines, and lot of other mines are revamping up their production. Also, OMC is also revamping up the production from their 3 mines from 14 million tons to around 40 million tons. And also you will be happy to know that, very recently there is the third round of auction process for the iron ore, which is going to be processed very fast in next few months. And I expect that by end of this year, we will see 30-40% of mines rolling out in the market from the new auction. So we are very comfortable, and see, we have overcome the challenges in last 17 years. So since we are very much near to the belt, we have so much distinct advantage of multiple sourcing of iron ore from the multiple miners under the long-term contracts and under the agreement with the government of Odisha and all. So we are very pretty sure that we will be able to overcome this challenge. Thank you.
Thank you, sir, for the elaborate answer. Just want to clarify, 6,500 rupees per ton for the quarter is the purchase rate or the consumption rate?
No, should be around the purchase rate. Should be a purchase rate.
I was checking about the consumption rate. What would be the consumption cost? Because that would be with the old inventory, right, sir?
So the present price, this is the purchase rate for the quarter, and the
consumption rate.
Yeah, consumption rate is 1.4, maybe around 1.4.
Yeah, as far as
yeah.
Yeah, can I elaborate about the consumption rate of the iron ore? Currently our consumption rate, because whatever with the iron ore which we have the average purchase price is less than 5,000 rupees per ton in the last 1 year. So our consumption rate for the first quarter is approximately less than 5,000 rupees per ton.
And for Q4, sir?
Q4. Our Q4 rate is approximately less than 4,000 rupees per ton.
So we can expect a jump of almost like 1,000 plus, almost 25% jump in the coming quarter, right, sir?
Near about.
Got it. Thank you, sir. Thank you for the answer.
Thank you, Arijit. Yeah.
Thank you. The next question is from the line of Deepen Shah from Crystal Investment Advisors. Please go ahead.
Hi, and thanks for the opportunity. I hope you can hear me.
Yeah, you're audible. Thank you. Yeah.
Okay. So I have 2 questions. One is, we've seen a reasonable working capital tightening this time around. Is this sustainable, or are we again going to slip on the days? Where do you see the business going? Because we also completed the first quarter, so you would have a sense there. Is the net working capital days roughly maintained at the tight level that you reported at the end of fourth quarter? Or will it be a little higher? When I'm trying to make numbers for this year, or on a forward-looking basis, what should we build in? Where are we headed?
Yeah, I appreciate your question, but this is a concern which we call it as an opportunity concern. It all depends in the market. What is the positioning we have to see? How we are seeing the demand and all. So we had been always working in a very, very strategically. So you have seen in the past also, we had been always performing with a double-digit growth in spite of so many challenges and all.
Right.
It all depends on the opportunity, vaisa risk and all, risk versus reward, So it all depends on time.
Okay, so you'll play it tactically, and especially things like inventory, you will kind of try to have a tactical approach to it rather than just an optimizing approach in terms of trying to reduce inventory all the time or something.
1000%. We have to see. We have to drive with our approach, futuristic approach, seeing the demand, markets.
Absolutely. No, I'm with you there. The second question, yes, thanks, Bhushan. So the second question is on the cash flows that we are generating, and we've generated more than 1,000 crores of operating cash flow in the trailing year, FY21. Now, I would suspect that much of this would have been generated in the blowout fourth quarter numbers, which itself is almost like more than 45 or close to 50% of the full year EBITDA. So I would suspect that much of the 1,000 crores, 1,049 crores of operating cash flow, maybe 400 plus, I'm just hazarding a guess, would have been generated in the last quarter. So I would, at the current run rate, and in fact, if anything, the first quarter of F22 would have probably been even better than the last quarter of F21. That's the sense I would have. So I wouldn't put it beyond you to, kind of do a much better operating cash flow this year. And which brings me to the question that your 3,000 crore capex plan, subject to, of course, cash flows remaining healthy and, on an improved run rate even versus F21 in this current year, you can probably accelerate your capex, and maybe guiding for less than 1,000 crores of capex this year looks very, very conservative to me. I know that it's a function of many outcomes which you can't predict today, but if you were to generate very good cash flows, can you technically accelerate and crash the schedules for your capex?
No, very, very well advised. Thank you so much. I appreciate in detail you have gone through in the total process. But kya hai na, you have seen this industry has been always very tricky.
Yes.
And today we are answerable to more than 250,000 shareholder family of our company, and our approach in the past have also been very, very prudentative,
Yes.
So I appreciate your concern, but we don't want to overcommit and underdeliver. So this
Super.
has been our principle in the past. If the time comes and if we see, we do have a mechanism in our quarterly board review of the project, monthly board review of the project, to see the larger interest of the company and take the action accordingly. But I totally appreciate your concern, and we will try to see how better we can improve it after your question.
Yeah, so you've actually answered my question, Bhushan, because in case you do generate the cash flows, the thing I'm asking is, there is a technical headroom that if we have the money, we can surely expand faster.
Okay, we also have a capital allocation policy, we have a dividend policy.
Right, there's dividend also.
Expectation has to be rewarded in all aspects, no?
Absolutely.
No, very well,
okay.
Very well.
Fully with you, sir. Thanks very much.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Mukul Verma from Verma Associates. Please go ahead.
Yeah, good evening, sir, and congratulations for a fantastic set of numbers. Just wanted to understand how has Q1 been in the wake of second wave? Has there been more disruption or things have been normal at the plants?
मुकुल भाई नमस्कार.
नमस्ते सर.
आपका प्लांट एकदम बरोबर चल रहा है Q1 में. बस आप हफ्ता 10 दिन वेट करिए, हम लोग रिजल्ट डिक्लेयर करने वाले हैं.
Oh, fantastic. Superb. All the very best, sir. Thank you so much.
God is very kind. God is very kind. Yeah.
Thank you. Superb. Wish you all the very best, sir.
Thank you.
बहुत अच्छा लग रहा है देख के, सुन के कि the gearing ratio is so very less, and wish you all the best to keep up with it, because wherever we see such companies, there is huge debt on books, and that's where the things go wrong. So I think you have a great future ahead of you, sir.
Thank you, Mukul bhai. Thank you so much.
Thank you. Participants, to ask a question, you may press star and 1 now. The next question is from the line of Mihir Shah from Axis Capital. Please go ahead.
Hello, sir.
Yes, Mihir, please.
Hello, sir.
Yeah, audible, yeah.
Yeah. Actually, question is, you are going to expand in the aluminum sector, right? Aluminum foil sector.
Bilkul,
Yeah.
bilkul.
So, what is your next plan for the EV battery? Because the basic raw material required are imported from the China for the EV battery, like aluminum, cobalt.
हमारा कोई बिजनेस प्लान आपको मिल गया क्या?
No, I have read that on your website.
अच्छा, आपने देख लिया क्या?
Yes.
वेरी नाइस. एल्यूमिनियम फॉइल की तो हाँ नहीं ठीक कह रहे हैं आप. You can carry on your question. Fine.
Yeah, because it is the very, next generation is totally on the next gen business is totally on electric vehicle. The parts and components and the basic raw materials required are for that only.
See, aluminium foil itself is a great niche product. Today with the revolution in the healthcare business, in the
every sector.
Sorry, can you hear me?
Yes, yes.
In the packaging business, so there is a huge shortage of aluminium foil. So in the first phase, we would like to commission the foil as a backward integration for the packaging industry. And since we have a facility to, in future, convert it into a EV battery product, but I don't want to commit anything to my shareholders and build a over ambition. But I would like to restrict myself with the idea that we have to first start with ABC and then look after MNO. So for first few years, maybe 1.5, 2 years, we have to completely focus in stabilizing the plant. And this business of the foil packaging is also a very, very interesting venture. We have imported the plant completely from Germany. It is world best plant and it is the latest plant and one of the largest single unit foil plant in the country. We expect to commission this plant in the third quarter. By fourth quarter, we should be able to regularize this plant if everything is within the parameters and all. And then later on, once the plant is fully stabilized, the product is fully stabilized, we will think of going one step ahead in future once we achieve the goal A target.
Okay, thank you, sir, for the information.
Thank you, Mirba. Yeah.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Chirag Mehta from Chirag Mehta and Company. Please go ahead.
Am I audible, sir?
Yes,
hello.
Sir, go ahead.
Yeah. Am I audible? Yeah. So, sir, congratulations on the stellar performance of the company. As regards the capex is concerned, I just wanted to know what asset turnover we are looking at. And my second question is, as far as the company's date is concerned, can I say that another 4-5 years we expect 20-25% growth in the company on a very prudent and a conservative basis?
हाँ चिराग भाई हाँ नमस्कार ऐसा है अभी तक जो भी प्लान है एकदम उसके हिसाब से यस हम डबल डिजिट ग्रोथ जो टारगेट कर रहे हैं ऐसा भी लग रहा है होगा और Q1 का रिजल्ट अभी विद इन नेक्स्ट 7-10 days वी आर टारगेटिंग टू डिक्लेयर द Q1 रिजल्ट उसके बाद we will evaluate further and we will give you the detail synopsis of this year after the Q1 result is over, because Q1 result is very important to streamline the overall year wise. So we'll be more comfortable discussing this concern after the Q1 result. Related to
Hello? 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 Hello?
Sorry?
The revenue last year, 2021, was 991 crores as far as exports is concerned.
Okay. So, this was a pandemic year, and first 2 quarters had been very, very tough from the overall global scenario. And in spite of that, we had a great decent share on the export revenue, also on the total revenue. So we did a turnover of around 990 crores on the overall revenue of around 6,300 crores approximately. So with the kind of diversified products what we have in our total value chain, supply value chain, you beat pallet, you beat DRI, you beat billets, you beat long products, TMT, structures, pipes, ferroalloys also, we make chrome, we make manganese, silico manganese, so many products are there. So it's a very diversified basket. So we have a very good flexibility, like if there is any pressure due to the COVID or any kind of a condition in any kind of product, we are able to diversify to the other products. Either it is the intermediate products or maybe, we divert to the other products. So we make sure that from the operational point of view, from the efficiency point of view, we should least suffer or no suffer, I would say. So this is a great advantage in our business model. Like we are not making only one product. That if there is any kind of a pressure in any one product and every cycle from the bottom to the top, it gets disrupted. So this is a very interesting business synergy in our business. And that is the reason, in last 15, 17 years, the three tough weathers of 2007-8, you beat 13, 14, 15, you beat 17, 18, and you beat 20. So we had been able to overcome all the challenges with our prudent approach and our business strategy in the terms of diversified products, also in the terms of the cheap availability of raw material, where we are least dependent on the imported raw material, or we can say we can run the plant without the import as well. Also, we are insulated from the import threat of our product what we manufacture. I can very proudly state that it is a very, very interesting model. If you see, in the year 2015-16, we were seeing a lot of dumping of steel was happening in the country. And a company like us, we were growing double digit because we have invested in a businesses where we have not seen any kind of an import happening in the product. So all these synergy really helps at a healthy planning and also helps us to de-risk our business.
Sure. And sir, to the other part of the question, what capacities in the intermediaries and the finished products should be commissioned, if you can share at least for the next 6 months? So it will give us some sense of the volume growth in the next 6 months or the target volume growth for the fiscal 22, intermediaries plus finished products.
Deepak, can you state this?
Yeah. As far as expansion capacity is concerned, we will be commissioning in the current financial year of approximately 2.2 million ton capacity, which comprise of 1.2 million ton of pallets, 0.9 million ton of sponge iron, and long product is small capacity of 1,20,000, which comprise of 2.2 million ton. Some of the capacity will be commissioned in the third quarter, and rest capacity will be in the third and fourth quarter. The capacity will be commissioned.
Sure. And sir, the volume growth versus the 1.18 million tons is what we did in fiscal 21, right? So what sort of a growth are we looking at now that most of these capacities will come in the third quarter? I'm talking about the finished, not the pellet plant, finished and intermediary sales. So what kind of a volume growth will be possible for us?
So if you see last year in terms of volume growth, we have done about a 34% growth. So this year from 1.18 in case of finished steel and all, we should be doing something about 1.95 to something like that. So that you can then back calculate the growth. So it will be around that percentage only.
And most of it will be on the DRI side because the DRI comes first and then the long products come in the fourth quarter.
Absolutely.
Sure. Thank you so much, sir.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Yeah. Hello.
Yes, you are audible.
Yeah. Thank you, everyone. And I take this opportunity to thank everyone for joining on this call. I hope we have been able to address all the queries. In case you require any further details, you may contact to Mr. Pankaj Halalka, our head IR, or Mr. Deven Dhruva from Orient Capital, our investor relationship partner. धन्यवाद, थैंक यू, और बहुत अच्छा लगा आप लोगों से सबसे बात करके. और कोई भी आप लोगों का क्वेश्चन है, कोई भी और कंसर्न है, आप लोग बात कर सकते हैं पंकज जी से, ध्रुवा से, और it will be good for us to learn and improve if there is any suggestion by any of our investors. Thank you so much.
Thank you.
Thank you, everyone, from my side.
Thank you. On behalf of Shyam Metalics and Energy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.